Markets are not driven by ideals. They are not driven by virtue. They are driven by incentives. Human beings allocate capital, time, and effort according to perceived advantage. They do not require moral perfection to function. They require alignment. When incentives reward productive behavior, society advances, even when individuals act primarily in their own self-interest. This is not a flaw in human nature. It is its most reliable feature. You already understand this. Every decision you make, to save, to invest, to delay consumption, is guided by expectation, not intention. You do not invest to improve the world. You invest to improve your position within it. And yet, when millions of individuals do the same, the aggregated result determines the structure of markets, the allocation of labor, and the trajectory of economic growth. This coordination does not require instruction. It does not require supervision. It emerges. Investment, at its core, is the postponement of consumption in exchange for expected future gain. To invest is to choose tomorrow over today. Societies that reward this choice accumulate productive capacity faster than those that discourage it. Capital does not seek virtue. It seeks reliability, return, protection from arbitrary loss. Where these conditions exist, economic activity expands naturally. Where they do not, capital retreats, or transforms into speculation. This distinction matters. Speculation is not investment. It is a response to uncertainty. Investors do not flee risk itself. They flee uncertainty that cannot be calculated. Risk can be measured. It can be diversified. It can be rewarded. Uncertainty destroys calculation. It collapses time horizons. It halts long-term commitment. And without long-term commitment, no society accumulates durable wealth. Markets coordinate not through intention, but through adjustment. Supply responds to demand. Demand responds to price. Price responds to scarcity. This process requires no central mind. A price is not merely a number. It is condensed knowledge. It reflects scarcity, preference, risk, time. No individual possesses global knowledge. Yet price allows individuals with limited information to act as if they do. When prices are allowed to move freely, they guide capital toward unmet demand and away from inefficiency. This guidance is more precise than any directive authority could achieve, but it rests on assumptions. Property must be secure. Contracts must be enforceable. Rules must be predictable. Without this framework, prices lose meaning. Capital no longer evaluates opportunity. It evaluates survival. And when survival becomes the priority, investment shortens its horizon. Liquidity replaces productivity, and growth decelerates. Wealth is often misunderstood as a zero-sum contest. One gains, another must lose. This belief persists because it feels intuitive, but it is false in productive economies. Wealth emerges from expanding output, not redistributing fixed supply. Specialization increases efficiency. Innovation increases capacity. Capital deepening increases throughput. The division of labor reduces transition costs, improves proficiency, and enables mechanization. Output rises, but specialization also narrows perspective. Efficiency increases, while holistic understanding declines. From an investment perspective, specialization raises returns on capital by lowering marginal cost. Yet it creates interdependence. Interdependence amplifies shocks. When disruption occurs, systems optimized for efficiency prove fragile. This is not an argument against specialization. It is a reminder of its trade-offs. Investment is not certainty. It is probabilistic judgment over time. Returns exist because uncertainty exists. Interest rates reflect this balance. They signal society's preference between present consumption and future reward. When these signals are suppressed, investment decisions distort. Capital flows toward projects sustained by cheap credit, not genuine demand. Apparent prosperity masks fragility. True growth originates from productivity gains, not balance sheets expanded without real output. Profit is often morally criticized. This criticism misunderstands its function. Profit is not virtue. It is measurement. It measures whether resources are being transformed into goods and services valued by others. Persistent profit attracts competition. Competition compresses margins. Efficiency increases. Persistent loss signals misallocation. Capital must move. This process disciplines entrepreneurs and investors alike. It rewards foresight. It penalizes complacency. But profit loses meaning when competition is restricted, when regulation protects incumbents, when privilege replaces performance. In such environments, capital accumulation becomes extractive. Wealth concentrates without increasing prosperity. Long-term investors must distinguish between returns derived from innovation and returns derived from artificial scarcity. Only one is sustainable. Economic systems flourish when failure is permitted. Bankruptcy is not merely legal. It is reallocation. It frees resources from inefficient management. Preventing failure preserves inefficiency. Eliminating consequence invites recklessness. The balance between these extremes defines investment culture. Trust is equally foundational. Where trust is low, transaction costs rise. Capital demands higher returns to compensate for enforcement risk. Development slows. Opportunity contracts. Trust does not emerge from sentiment. It emerges from consistency, repeated interaction, reputation, predictable enforcement. The invisible hand is often misunderstood. It does not excuse moral indifference. It functions only when ethical restraint and institutional integrity exist. Without them, self-interest degenerates into opportunism. Markets fragment. Time horizons collapse. Investors shorten commitments. Liquidity replaces construction, and compounding dies. Time horizon defines investment behavior. Short-term actors exploit volatility. Long-term investors depend on stability. Compounding is simple in theory, relentless in practice. Its power does not come from extraordinary returns achieved briefly, but from moderate returns, sustained consistently, over extended periods. This reality favors environments with predictable governance and restrained intervention. Excessive interference introduces noise. Noise inflates risk premiums. Capital retreats from productivity. Labor, like capital, responds to incentives. Wages reflect productivity, capital intensity, and bargaining conditions. Attempts to raise wages without raising productivity produce distortion. Investment in human capital raises labor productivity, which raises wages and returns on physical capital. This creates reinforcement. When education disconnects from demand, credentials inflate, productivity stagnates, expectations rise without capacity. Investors must evaluate not only current labor costs, but skill trajectory. Technology alters capital-labor relationships. Tasks disappear. Output increases. Over time, new opportunities emerge. Resistance preserves structure temporarily, but reduces competitiveness. Capital seeks adaptation. Perceived fairness affects stability. Stability affects risk. Inequality born of innovation can be tolerated if mobility exists. Equality born of privilege invites intervention. Predictability matters more than ideology. Investors can adapt to many frameworks. They cannot adapt to uncertainty. Markets without oversight can concentrate power. Oversight without restraint suppresses discovery. The challenge is institutional design. Capital markets function best when information flows freely. Entry remains possible. Exit remains allowed. When these conditions deteriorate, returns derive from position, not performance. Ultimately, capital does not merely respond to the economy. It helps create it. Investors shape incentives through allocation. This responsibility does not require altruism. It requires awareness. Sustainable returns depend on systems capable of endurance. Profit divorced from productivity undermines itself. Long-term wealth is built by identifying durable patterns of value creation and committing patiently within a framework of trust, competition, and measured risk. Every investor believes they are rational. Most are not. They react. They imitate. They extrapolate the present into the future. Markets amplify this behavior. Price movements create narratives. Narratives create conviction. Conviction attracts capital. Eventually, valuation detaches from reality. This is not a failure of intelligence. It is a feature of human psychology. Fear and greed are not opposites. They are siblings. Both distort judgment. Both compress time horizons. The disciplined investor does not eliminate emotion. He structures decision-making to survive it. Rules outperform intuition. Under stress, markets oscillate between excess optimism and excessive pessimism. Rarely do they remain balanced. Opportunity arises not from equilibrium, but from deviation. The patient investor waits for mispricing. The impatient one creates it. Speculation dominates when narratives overpower fundamentals. Investment returns when cash flows matter again. This cycle repeats because human behavior does not evolve at the pace of financial innovation. Information travels faster. Judgment does not. Liquidity magnifies volatility. When capital can exit instantly, commitment weakens. Short-term signals overpower long-term evaluation. Yet liquidity is not the enemy. Misuse is. Liquidity enables correction. It also enables panic. The difference lies in structure. Institutions that reward patience attract long-term capital. Those that reward speed attract arbitrage. Both have roles. Confusing them creates fragility. Debt deserves special attention. Debt accelerates growth. When deployed productively, it destroys resilience. When used to sustain inefficiency, leverage magnifies outcomes, not wisdom. Periods of stability encourage leverage. Low volatility breeds complacency. Risk appears absent until it concentrates. Then it arrives, all at once. Investors who mistake temporary calm for permanent safety are eventually corrected. Interest rates are not arbitrary. They are signals. Suppressing them blinds capital. Artificially cheap credit distorts asset pricing, misallocates labor, and encourages speculation. The consequences emerge slowly, then suddenly. Economic cycles are not anomalies. They are corrections. Attempts to eliminate them often increase their severity. Resilience does not come from avoiding downturns, but from surviving them intact. Capital preservation precedes capital growth. The first rule of investment is not return. It is survival. Time rewards those who remain solvent. Losses compound faster than gains. Avoiding catastrophic loss matters more than achieving extraordinary gain. Diversification is misunderstood. It is not protection against volatility. It is protection against ignorance. Concentration requires conviction. Conviction requires understanding. Most investors lack both. True diversification does not eliminate risk. It redistributes it. Asset correlations change under stress. Illusions of safety collapse simultaneously. Understanding system behavior matters more than optimizing allocation. Markets do not exist in isolation. They are embedded within political structures, social expectations, and institutional constraints. Policy alters incentives. Incentives alter behavior. Investors who ignore policy do so at their own peril. Yet investors who rely on prediction are equally exposed. Policy responds to pressure, not foresight. Adaptability outperforms prediction. The role of the state is often debated, but from an economic perspective, its most critical functions are limited and precise. Protect property, enforce contracts, maintain stability. Beyond this, intervention must be restrained. Excessive control crowds out private judgment. Insufficient control invites exploitation. Both extremes increase risk premiums. Capital does not demand perfection. It demands consistency. Corruption is not merely moral decay. It is economic friction. It raises costs, distorts allocation, and discourages participation. Where corruption persists, capital demands compensation. Where compensation fails, capital withdraws. No economy grows without trust in enforcement. Cultural norms matter. Societies that value thrift, deferred gratification, and reliability accumulate capital fast than those driven by immediacy. Consumption signals status. Investment builds capacity. Confusing the two weakens long-term growth. Wealth is not visible in spending. It is visible in optionality. The ability to wait. The ability to endure volatility. The ability to refuse unfavorable terms. These are economic advantages. They are built quietly. Narratives glorify success. They obscure process. Most wealth is accumulated slowly through repetition, discipline, and restraint. The myth of sudden fortune encourages speculation. The reality of compounding rewards patience. Capital markets punish arrogance. No investor is immune to error. Those who survive longest are those who adapt fastest. Admitting uncertainty is not weakness. It is strategic clarity. Markets do not reward certainty. They reward preparedness. Preparedness includes humility. It includes acknowledging what cannot be known. Forecasts fail. Scenarios endure. Investors who prepare for multiple outcomes outperform those committed to a single narrative. Economic progress is not linear. It advances through disruption, reallocation, and adjustment. Attempts to freeze structure preserve inefficiency. Progress requires displacement. This truth is uncomfortable, but unavoidable. Investment flows toward future productivity, not past achievement. Capital honors potential, not legacy. Those who cling to obsolete advantage lose relevance. Markets are indifferent to nostalgia. In the long arc, capital aligns with human ingenuity. Innovation emerges from necessity, constraint, and incentive. Suppressing incentive suppresses discovery. Over time, systems that reward experimentation outpace those that punish failure. Failure teaches allocation. Success teaches scale. The investor's role is not to predict invention, but to recognize adoption. Ideas are abundant. Execution is scarce. Returns accrue. not to the first idea, but to the first scalable solution. Capital accelerates diffusion. Those who allocate wisely shape the economic future without ever intending to. This is the paradox. Self-interest, properly constrained, produces collective benefit, not through virtue, through structure, not through intention, through alignment. This is the invisible hand, properly understood. It is not mystical, it is mechanical. When rules are clear, competition is open, and property is secure. Individual pursuit aggregates into progress. When these conditions erode, self-interest fragments into extraction. Markets do not fail randomly. They fail structurally. The lesson for the modern investor is neither optimism nor cynicism. It is realism. Understand incentives. Respect uncertainty. Protect capital. Commit patiently. Time will do the rest.